Phillip Capital is celebrating our 50th anniversary. Okay, move on to the disclaimer. Every year we mention this, so I hate to bore you with it, but again, this is purely for educational purposes. The information here is, we obtain it from public sources and we can't really verify. Now, if GDP in Singapore is so good, we can't really verify, is it really that good? This is purely for general circulation, and no, please refer to your financial advisor for whether these meet your respective needs or not. So, as typical, we will run through what happened in 2024. We'll spend a bit more time on review. We usually don't like to be backward looking, but we're going to just review 2024. What are the policies that you should expect from Trump? Again, as a Singapore investor, you may not directly impact you, but at least just to guide you what are the things, what are the headlines that you should expect, and then how is it going to impact your portfolio? We'll move on to my colleague, Zain, who will just give you some technical outlook, how you see Singapore market, the large caps, the small cap picks. We're just going for 3 themes for 2025 because it is really going to be hard to navigate 2025 because I spend most of my time just watching Truth Social, because whatever he mentions on Truth Social, which is the equivalent of Twitter, is going to dictate the market. So it's virtually almost impossible to kind of give you some framework what's going to happen macro-wise, but we're just going to have 3 themes that we hope investors can write on, and a bit more of a contrarian theme, our usual model portfolio, and then we'll end off with the closing remarks. So I'll just run through with you 2024. So what happened in 2024? So 2024 was a memorable year because we almost crossed the all-time high. Singapore market was about 2% below all-time high that was achieved in October 2007. It also means that after 17 years, the market just back to square one. So I guess if your advisor always asks you to invest for the long term, then you can always use this example. 17 years long enough to wait. But within the 17 years, to be fair, Singapore market did give around 4.5% annual returns if you measure. So although you did nothing the market for 17 years, you did get some dividends and you got like almost 4.5% return, which is actually better than some sovereign funds that invested in office malls in Australia, if you actually read the media. They also invested in 2007, but at least we still generate 4.5% a year. So if you look at this chart, 2024 was, of course, all about the banks. It was a stellar year for the banks. I think like DBS did like 43%. So don't have to look so far for any small mid caps, just buy DBS and you can call it a day. If you add on the dividends, you're talking about almost 51% return from DBS. Likewise, we got it from OCBC and also from UOB at 20+%. Our banking analyst Glenn will elaborate more. If you look at what were the big gainers, again, the Yang Tze was the big winner for this year, it's up almost 100%. One of the main reasons is because of the Red Sea conflict. Fed rates almost double, triple again, and then reordering happened, and of course they're benefiting from that. Of course, DBS, SETS was another one, which my colleague Myanmar will also discuss, was a winner. REITs was again the big losers. If you look at the chart on your bottom left, you'll notice that REITs were one of the weakest, and like Mapletree Logistics, if you have an asset with a China portfolio, your REIT will get sold down. So for them, they about 20% was from China, and then another 20% was from Hong Kong. So like 40% from Greater China, and investors will just sell you down. And of course, the rental reversions there was like negative. Genting also was one of the weak performers. Their results was poor. I think you could see it also in Las Vegas, Marina Bay Sands results too. So the impact is mainly on the high rollers, but I mean, if there's questions, we'll go on more to it. Frasers Logistics was the other loser. The big winners was, and you look at the bottom right, was just property, just to give you a sense of what happened. CDL, again, the RNAV can be $12, but it's almost like a value trap. So what if you're $12, you don't sell anything, so you end up getting sold down also by 20%. CapitaLand Investments was also weak. I think because of the China exposure, anything with China also was surprisingly. Hong Kong Land did well. Although vacancy rates in Hong Kong are still climbing up, but the share price performed because they said they're going to sell something. So selling furniture actually is a very good strategy. You just say you want to sell something, and then people will re-rate you, like what we've seen in a lot of the GLCs. I'll just run through what are some of the asset classes that did well for 2024. So for REITs, again, this is in US dollar terms, so the numbers may not be different. Like for Singapore, we are up about 16%, but in US dollar terms, it's about 13%. REITs again was weak. Asia Pac ex-Japan AP means largely a lot of China stocks in there. Then of course US was another second year of performance. Of course 2022 the US was down about 20%, bounced back up, and then again 2 years of performance. So it was like magnificent performance. Again, don't have to actually stop pick, just buy the whole US market and you're up 40% over 2 years. Bonds was down, so likewise similar to REITs, anything interest rate sensitive. Although ironically, this year the Fed has cut 100 basis points or 4 times. Interest rate sensitive stocks were still sold down. Gold, of course, was the big winner, and commodity was just generally okay, I guess. I'll just one last slide, second last slide on the performance. So this is just how did Asian equity markets in local currency terms. So like the title suggests, tech did well. I think Taiwan, of course, TSMC is almost the whole Taiwan index is probably all TSMC. So that did well. Singapore Financial, so banks again was a stellar performance by banks, even on the Asian, if you compare it to other Asian indexes. Despite all the bad press, Hong Kong also did well. Singapore was there about 17%, Malaysia 13%. Again, this is just for your reference. REIT, if you look at REIT as an asset class, again, it's one of the biggest, and of course Korea, we all know what's going on there. We'll end up the review as usual when we start off our last year's 2024. We always have some macro assumptions. So we are just submitting my report card, which is usually like basically just borderline passer. So actually we had 4 themes for 2024. We actually thought there were 2 rate cuts. In the end, it came up 4. We thought that there was slowdown in US, so it's kind of right. And since I'm marking myself, so I mark myself right. The asset prices we cover, I'm not really clear what assets, probably property prices. And we actually thought Chinese economy would be better than expected, but it didn't. So again, we always want to reflect on our macro assumptions so that at least when we give you another forecast, just to give you a sense of where we're coming from. So in terms of 2025, what are the themes that we are thinking? We still think there'll be at least 4 rate cuts coming in. We think, although Federal Reserve is guiding 2 rate cuts, but relying on the Federal Reserve guidance is as trustworthy as like that scorpion on the frog, because they always change their mind. So if you do a rewind in 2024, first quarter the Fed said that they're going to cut maybe 2 times. Then second quarter they said, I'm not going to cut. Then third quarter, they say, I'm going to cut 4 times. I'm going to do very aggressive cuts 4 times. Then come to fourth quarter, the Fed changed their mind again and said they're going to cut only 2 times. So in a way, going against the Fed has been a good strategy in 2024. But for us, we will go in more detail on our teams. So that's why we still like REITs. We think there'll be more interest rate cuts. Corporate restructuring, again, like selling furniture, we think will still be a profitable strategy in 2025. We'll go through some of the names, even though those we don't cover. And we think there will be a re-rating in Chinese equities. We're not saying Chinese economy is going to rebound, but we think we'll elaborate later that even though there will be tariffs, but the tariffs seem to be targeted not so much on China, but again, his neighbors, Canada, Mexico. And he's been, if you watch his Twitter feed or his social truth feed, he's a bit more softer on China. So that's why we think there could be a re-rating. Not that the economy of China will rebound, but just that the valuations, people will not be so negative on China. So I will hand over to Zain. He'll give you a technical, then I'll come back just to give you a run through more details on the strategy. Zain.
Thanks, Paul. Good morning, everyone. So I'm Zain. I'm the technical analyst. So today I'll be giving you a technical outlook for Singapore market and also give you all the large cap pick as well as small cap pick based on technical analysis. So firstly, talking about the outlook for Singapore market, this is the chart of the ES3 ETF on a weekly basis. So looking at this, as Paul mentioned just now, we are in 2024. We almost breached the all-time high. Currently, it's about 2.7% from the all-time highs back in October 2007. For this year, we do see an opportunity to break this all-time high. So looking at the ES3 ETF, it has actually seen 3 consecutive strong quarters, about 5 to 7% gains each quarter. So currently, it's about 2.7% off. For first quarter, we do see a bit of a slight consolidation at the start, at about 3.8 to 3.9 region. and thereafter picking up the bullish momentum again, as it's currently trading near the main uptrend channel resistance, which is highlighted in blue. Yeah, and this strong performance actually came off the back of since the chart broke above the uptrend channel resistance highlighted in black in May to June this year. Yeah, so we do see an opportunity for this bullish trend to actually continue in 2025, with our first quarter target being at $4, which is about a 3% upside from current levels. Then moving on to our large cap pick, is actually we have Thai Beverage. So for Thai Beverage, in terms of the chart, we do see a bullish reversal actually taking shape. So from the chart, we can actually see that since 2023, the price has actually been on a downtrend, but there have been some positive developments recently, especially since September last year, where we see the stock actually broke off an inverse head and shoulders formation of the neckline resistance at 52 cents, which is highlighted in blue. And subsequently, it did a consolidation from September to November, after which there was another significant price action, which was a bear trap pattern being formed at the start of November, where price actually did a false breakdown below 52 cents, and subsequently there was a recovery. So this bear trap, I think, is actually quite significant because in technical analysis, this could actually force those short sellers to actually cover their position in view of the rising prices that actually took place afterwards. Then subsequently, towards the end of 2024, we saw that the price actually found support at 54.5 cents, which was actually a prior resistance levels. So all in all, since September, we do see a very nice bullish reversal kind of price action taking place. And we do see that the price will actually head higher up to continue this recent bullish reversal towards 64 cents, which is the highest formed in April 2023. That's about a 12.2% upside from current levels. We do also have a fundamental buy recommendation on Thai Beverage, also with a target price also at 64 cents as well. The next one is our mid-cap pick. We have Zixin Group Holdings. So coincidentally, for our large cap pick and mid-cap pick, for this time, we actually selected some stocks that we do have in our fundamental coverage, but that's not always the case because we also do look at the broader market as well to see if there's any other good recommendations. So talking about Zixin, Zixin is actually a Chinese sweet potato focused operator, which my colleague Miao Miao will share more about later. So for the chart, we do see a potential bullish continuation for this counter because since the story is actually quite similar to Thai Beverage. Since September last year, there was a breakout of the 2.2 cents horizontal resistance level, which actually kick-started this bullish reversal, where price actually went up towards 3.1, 3.2 cents level, and is currently doing an ascending triangle formation, highlighted in blue. So this is a bullish kind of formation that we want to see where there's a similar highs, but higher lows being formed. And it came off the back of the 2.5 cents level, which was a prior resistance turning to a support. So all in all, a lot of bullish signs are forming for this counter. And we do see that should the stock break out above the current resistance at 3.1 to 3.2 cents, it's most likely going to retest the 3.5 cents resistance formed in August 2023. So that's about 12.9% upside that we could expect from this counter. Yeah, so that's all from me for technicals. I'll hand over time back to Paul, where he will talk about what Trump could bring to the table this year. Thanks.
So thanks, James. Sorry for us switching around. Okay, so I'll just run through what we expect from Trump's policies, shock and awe, because anything can happen. Again, this is more to equip you and get ready what you're going to expect. It's going to be hard to trade around it because most of these are very US-centric, going to affect various US sectors. So that's Trump riding on a roller coaster since it's shock and awe. Okay, the first one to expect, at least from the headlines, is mass deportation. So there's an assumed 10, 11 million of illegal immigrants in the US. Actually, I was in the US last week. So that is going to be one of the things he's going to do. So on January 20th, he might announce a lot of deportation. The chart you see here are those illegals that have been registered pending court processing. But you'll notice that during the Biden administration, that was where you saw the big spike up. So what is the impact? So what you should expect is that it depends. The assumptions could be maybe he's going to deport 1 million or 8 million. So what is the impact? The impact will be agriculture, because I mean, if you drink a lot of wine, you know that all these grapes are hand-picked and you need a lot of labor. So the impact is more centric on agriculture. Singapore investor, I mean, I guess we're not that affected, maybe less wines from US, but the other thing to worry about is inflation will probably pick up, and also there could be a hit on GDP because this is equivalent to a COVID labor shock. You know, like during COVID, there was lack of workers, and this is equivalent to it. So this is something to watch. Again, just for information, I'm not going to trade around it. Of course, the more important one from Singapore-centric will be tariffs. So there's all kinds of numbers. You may impose 60% on China and then 10% on everyone, because he's already hitting some on Canada. So the chart here is countries that have a trade balance, trade surplus with the US. So even though tariffs have been imposed on China, China is still the biggest. But what we worry is on the ASEAN part here. So even though he has imposed Canada, which is the neighbor, he's also imposed tariffs. So he could also do it on Vietnam is on another possible candidate. And again, once this hits the news, of course, you probably get a sell down in Southeast Asian countries. So the biggest worry is that it's going to inflame a global trade war. The biggest one is probably near term could be Canada. Then there could be a tick for tack, and it could actually pull the whole global market because everyone will be worried. Corporates will also be hesitant. Supply chains will be disrupted. So that's the negative impact for trade. If there is a global trade war happening, services no impact. Of course, there'll be impact on inflation. The one positive could be is that if he really hits China, then of course we always hear this China plus one. That means most manufacturers have a plant in China, then they have something in Southeast Asia. So maybe it could be I'm just thinking this out. Maybe it's minus China and then just everything all in Southeast Asia, which makes sense. But I guess the pertinent point here is that anyone is susceptible. Not Singapore, because we have a deficit. So actually, we have a deficit with US, so he may not hit us directly, but he will hit, most of the manufacturers we have listed here in Singapore, could be our Venture, could be our Franken. Most of their operations are in Malaysia or even in Vietnam. So once that hit, that's going to hurt the Singapore market. And this thing can happen anytime. That it could be that overnight on Truth Social, you could just mention, I want to impose some tariffs on Vietnam. Nobody knows. The other thing to watch is that he will try to push the US economy. So fiscal deficit means the government spending. So if you look at this, again, we showed this chart before. So on your left is all those countries with AAA. Of course, Singapore is there. Don't worry on the high debt to GDP because Singapore technically doesn't have a fiscal deficit. It's always balanced. It's just that we issue debt just just to get some pricing out of bonds. But again, we are the only Asian country that has a AAA rating. Again, this is just advertising since this is an important year for everyone, I guess. The thing is that if you are Trump looking at this chart, like US is 123% of GDP. That means this is how much debt the government has. Of course, it's been climbing, but in a way, the higher the debt, the stronger the US exceptionalism. Because even though fiscal deficit keep on rising, the US dollar is even stronger. And even at 123, they are like Japan is higher, Italy is higher. So the message here is that don't be surprised if Trump will stimulate the economy even more, because to him, I spend more, stock market is even better, the economy does better, US dollar does better, so why not? Of course, the bonds interest rate has been higher, but again, you balance it off, it's still much better for him to just spend it on. So one of the things he's going to do is that this is a bit more nuanced, and maybe not everyone will follow, but he's just going to cut taxes, and all this is just for your reference. So, and then the deficit, based on the current forecast, is about 9.8%. What this means is that if you have a deficit, of course, it's a good time. Everyone's going to have a good time when you have a deficit. Okay, the other thing to watch, again, this is a bit more nuanced. You just take note of. Of course, the other thing they want to do is to cut the expenditure. So it's a strange thing, but that he wants to raise expenditure, but at the same time cut it and make more efficient. Our view here is that it's going to be very limited. It's going to be very hard for Elon Musk to cut. Firstly, because most of the spending is in blue, is mandatory, is forced. You have to spend this money. You have to give social benefit. You have to give medical in blue. There is a little bit balance here that is non-military, but at the same time, like it's going to be very hard to cut because every politician won't want to have their state, their particular state to have cut. So imagine if you want to cut a military base in a particular politician's state, he's not going to agree to it. But again, this is just for a reference. I won't go too much to it. The other thing to watch is, of course, there could be more hostility towards Iran. So this could hurt oil price, but we think it may not be material. So the lines you see here, sorry, very messy, but the blue line here is US oil production. Red is Iran, and then of course Saudi Arabia. So even though he may be more hostile, maybe Iran sanctions may happen. We don't think it will destabilize the equity markets because there's a lot of capacity. So assuming you see the newspaper, so all these things are just to what's going to happen in your newspaper tomorrow. So even if there are Iran sanctions, we don't think it's going to destabilize price of oil because it could only reach 1.5 million barrels, but again, Saudi has 3 million spare, UAE has 1.5, and even globally, supply is going to rise 1 to 1.5. So we're not too worried again. But again, it's just for information and for you to be aware of. So I'll just run through the 3 key themes, then I'll hand over to my colleague. So the first theme we think will be lower than expected interest rates. So of course, the most important thing is why. So for us, this is where we think inflation is going to trend. So of course, the Federal Reserve looks at this and decides whether to raise interest rates or cut. So the most important one is the red line. So if you look at the red line, we think by 2025, interest rate inflation is going to come off. It will still be a little bit hot recently, but we think it will start to come off. Mainly 2 reasons. Firstly, there's the base effect because last year, 2024, it was exceptionally strong. So when you do a year-on-year, it should be lower. And secondly, the most important is not in the chart, it's the shelter inflation. I won't go through this technical. I think most of us just want to know what's fixed, but why? Because the inflation is very important. There's one that's hurting REITs. So if you recall, September REITs did very well. Then when the market thinks because of the Trump victory that interest rates won't be cut so much, you saw that REITs are coming down sharply. So that's why we actually eyeball this very closely. But again, 2025, that's where we think interest rates are coming down based on the trend line of, inflation. But regardless, I think globally, there's going to be a lot of interest rate cuts. So these are the projections for interest rate cuts for the main countries like US, Australia, EU, Japan. So of course, why we put Australia? Because a lot of REITs hold assets in Australia. Australia, you notice they haven't cut at all. I'm not sure why, because they are the most hawkish in terms of cutting rates. But even Australia will cut rates. So again, this will be supportive of REITs. Europe has been the most aggressive, and we think Europe will again in 2025 cut at least 4 times. Why we always emphasize on Europe? Because we have a buy call on Cromwell. So, but the message here is basically globally, there's still going to be a lot of interest rate cuts coming, except for Japan. I know Japan does their own thing. Okay, I'm going to hand over to my colleague Glenn. He'll just run through banks. Then he'll pass it on to Darren, who'll just run through REITs, and then we'll come back again. Thanks.
Hey, thanks, Paul. Yep. So now on to the banks, Singaporeans' favorite stocks and sector. And so basically just doing a very quick 3rd quarter review of how the banks did. And I think it's also sort of a predictor into their 4th quarter results. But just very quickly, if you look at the first red bar here, so the red box here, sorry. Yep. This shows you what was what actually made the banks did well in the 3rd quarter. It's mainly their fees and commissions. So that contributes, I think, a majority of the boost to their PATMI. And I think fees and commissions, most of it comes from the wealth management sector. And so we're looking at wealth management products, like your investment products, sort of things like that. And the second thing that actually the factor, that was very positive for the banks was this trading income here. So, with the heightened volatility surrounding Trump's sort of win, this caused the markets to react. And then, we saw this huge increase in trading income for the banks. So they do benefit quite a bit from this heightened volatility. I think it's 2 consecutive we'll probably see 2 consecutive quarters of this. So the 3rd quarter mainly came from the yen carry trade, which is why we saw this increase in trading income. And in the fourth quarter, we'll probably see it again coming from Trump's elections and his win. So this will probably be quite good to watch in the coming quarter results, which is the fourth quarter 2024's results. And last but not least, you see that the PATMI or the earnings, it's all been quite good, like almost double digit for all across the board. Although the NIMs and net interest incomes have both sort of declined from the record highs that they had during the high interest rate period. And just to highlight, lastly, in this last box here, we did see this huge bump up in CET1 for the banks, mainly due to the new Basel IV requirements. So, but however, the banks do report in like they call it fully phased in. It basically means, what happens after a couple of years when their equities have to go back down to normal. But surprisingly, only UOB is the one that still, they still announced a fully phased in CET1 that is quite a bit higher than it was the previous year. The other banks managed to sort of lower it down. And I think they attributed that to the fact that they have a lot of loans in SME and their portfolio is mainly due to the SMEs. So which is why, we see this huge, I think 2% sort of bump up in UOB CET1. I'll go on more about UOB in my later slide. But let me move on. So this is not really a recap, but Paul did touch upon this a little bit earlier. It's mainly the bank's stellar 2024 performance. So you can look at this box here. It shows, you see the banks, I think DBS is like 45% and OCBC UOB is like 28%. So we can attribute this, a good set of performance, mainly due to this, factors here, 5 of them. The first one I went through, it is the strong set of earnings. We do expect fourth quarter to be equally strong. Secondly, the fee income recovery. So, the banks have managed to sort of offset their net interest margin and net interest income decline by, banking on another segment of their business, which is the fee income. And thirdly, the net interest income and net interest margins decline have also been lower than expected. I'll touch upon more about that later. And the fourth one is that, they do have very healthy capital ratios and the dividend yields are also extremely high. I think, at the peak, we were seeing it reach about over 6%. So I think it will hit 7% for a period and then it went back down as the share price increased. So we are still looking at around 5% for a bank, which is extremely healthy. And last but not least, with Trump's win, the lowered rate cut expectations have also benefited the banks. So it's a bit of an inverse to the REITs, where it affected them negatively. But for the banks, suddenly you saw their share price shot up right after Trump's win, mainly due to these factors. So I'll just go into each of these factors one by one with a graph as well. Yeah. So the first one, I think I mentioned earlier about how the net interest margin and net interest incomes have not declined as much. I'll just explain this chart like a little bit first. So the orange line you see here, this one here, hopefully you can make out as orange. Yeah. So that is the Singapore interest rates, the SORA, and then the red line here, that would be the bank's net interest margin. And lastly, these blue bars here are the bank's net interest income. So this is a total of all 3 banks. You can see the SORA or the Singapore interest rates have started to dip. This is as fourth quarter as the rate cuts do come in. But what's interesting is that the net interest margins have only declined slightly. So that's very healthy for the banks. And more importantly is that their net interest income has not declined. So while net interest margins remain flat, and the interest rates are going down, but surprisingly, net interest income hasn't gone down. And why is that? You might ask. It's mainly due to the fact that the Singapore banks have a lot of excess deposits. So, a lot of their current account, savings accounts or fixed deposits that you put in with like DBS or UOB, they put that money and then they go and like sort of put it into higher interest earning assets. So what they're doing now is they're putting more of these excess deposits into to roll over into like treasuries or whatnot. So that's how they are able to maintain their net interest income for the banks. And also a very important factor for the banks, what we are seeing is that they're able to lower their funding costs by sort of clawing back some of these fixed deposits. If you remember a year ago, fixed deposit rates were extremely high. I think we could get like 4+% with a local bank. But what's happening now is all being lowered as the interest rates come down. So all these investors like yourselves or shareholders, they put the money back into current account. And that's virtually, I think it's like almost free money for the banks. So that's how they're able to cut their funding costs but yet, reinvest some of these excess deposits they have and then maintain their net interest income. So it's very different from, a bank in, let's say in the US, where you see their net interest income does go down with the interest rates. But for Singapore banks, they are quite a different case where they are able to maintain that. So that's one of the positives we see going into next year. So while interest rates will continue to decline and we do expect cuts, but Singapore banks particularly are able to maintain more importantly, their main source of revenue, which is net interest income and also their net interest margins. Yeah. So another one, so if that is being maintained, then you'll be asking the next question is, how are they able to, to improve on their earnings, right? What would the growth be? Where would the growth be coming from? And that will be coming from the fee income, right? So this is what we titled it as fee income because continue to surge. Let me explain this graph here a bit. So the orange line is their fee income, the three banks, and then the blue bar here is AUM. So AUM is assets under management. It's basically the banks, the funds that they have. Like if you invest $1 million with them, so this falls into their AUM or assets under management. So what we have seen is that the bank's fee income have reached a record high. And more importantly, apart from it reaching a high, we can see that the AUM has also been growing, right? So this is really due to the heightened capital markets activity. We have seen it increase the AUM, and also the margin has increased. So that's very important for the banks. If you look at here, this section, even if you look at the blue bar, it's quite stable. But what happened was that their margins crashed. And why is that so? As I mentioned earlier, the fixed deposit rates were very high. And this earns the banks, close to nothing. So a lot of people were putting their money, instead of going to like riskier investments, they just say, they tell their relationship manager, I want to put it into a fixed deposit. And then they'll be like, oh, okay. But then again, the margins they earn are so little, which is why we see this drop, crash. So AUM didn't really move much. AUM actually went up. But their fee income crashed so much because of this, what we call shifting into lower risk investments during the high interest rate environment. But now we are seeing this turnaround, mainly due to the interest rates coming down. Banks are not offering high interest rates or like low risk, high interest sort of investments anymore. So, investors are feeling that, okay, maybe now's the time to go back in. And hence, they are going into investment products and whatnot, which is why we see this huge increase, as well as the increase in the margins that they get as well. So that's one of the key factors. And going into next year, we believe that this will be one of the, a driving factor for the bank's earnings, as they continue to build onto their AUM and to try to further the spread that they have. I think all three banks have mentioned publicly that they are trying to expand their RM pool, their relationship manager pool, to reach more and more people. So that's a very positive news for the banks. Now, the next one, I think this is also a very big one, which is the loans growth. Loans growth has been quite stagnant for the last, I'd say 2 years. Yeah. So it has finally reached, as of November, it has reached this 26-month high at 3.3%. I think I haven't seen this figure in a long time, when it went above 3%, right? So, again, due to the high interest rates previously, loans growth also declined. So we saw, this loans growth actually declined quite a bit. But recently, even though rates were still high, we saw it pick back up. Right? I think maybe it was just that the investors and the people who were taking up loans maybe felt it was, they didn't really have much of a choice. Hence, that's why they had to take up loans. But now, with rate cuts finally kicking in, we could see a further increase. So, we're looking at possibly a mid-single digit, but I think on the high end, it could even be high single digit loans growth for the banks. Yep. So the sectors that did well were the building and construction segment. Housing loans were always stable, I think around low single digit sort of range for the banks. And lastly, but the manufacturing segment is still quite lackluster. So I think that would be the one, if it could pick up, it could possibly be beneficial for the whole sector, more particularly for the banks. Yep. So so this is the one I was talking about, the CET1, high capital ratios and, the very good excess capital. So the banks have seen, let me explain this graph a bit firstly. So this orange line here is just dividend yield and the blue bar is CET1, which is common equity tier 1. That, if you layman's terms, it just represents the capital or excess. We can see how much excess capital the banks have, right? So we have seen it shoot up recently, and we do expect it to continue to rise, right? So we are seeing CT1 at this all-time high, and there's also excess capital across the board of around $2 to $4 billion. Right? And this is very, I guess, a lot of Singaporean investors, they look at it and they're like, oh, does that mean that we'll get more dividends, right? Because they have to return. That's one of the few ways that they can return capital to shareholders. And yes, I do think that possible increase in dividend yield is we could look forward to that, maybe in this fourth quarter's results, and also possible share buybacks. I think two of the banks have sort of introduced that. So DBS has mentioned 3 billion, but no timeline and nothing much so far. UOB has also mentioned possible share buybacks, but don't even have the amount or the timeline. So that could be a possibility. So share buybacks will increase their ROE as well as EPS for the shareholders. Yeah, I think more importantly is that we do hope that there will be some increase in the dividend yield going into the fourth quarter, as well as more importantly into FY25 as they try to spend this excess capital that they have. So that's the banks segment. Now we're going into the two stock picks for the banks that I have. First one being OCBC. I think the title here explains it all. It just shows that excess capital of 4 billion Sing dollars. So for the banks, when we try to do the stock picks, we don't, I'm not going to talk about fee income and all that stuff because across the board it's the same, right? Net interest income is quite similar. We'll try to find topics that are separate the banks from another bank, let's say from DBS. So for OCBC, it would be that their CET1, it's at the 9th month 24, it's at 15.6%. And it's still the highest amongst the three banks. They have always been historically, I think for the past couple of years, having the most capital. I don't know whether is it because they don't really want to spend money or they are trying to hoard it for a rainy day. Yeah, but when we ask them, they say that their optimal CET1 is 14%. So what does that translate to is that they have excess capital of $4 billion. And where does this money have to go? It either has to go, they can do two things. They can do an acquisition or they can do give back to shareholders, right? They have tried to buy GE, but I think it still hasn't gone through yet fully. And the other option is to give back to shareholders. So we did ask the management, are they going to give back to shareholders? They said that now it's a possibility. Whether or not it will come true, it will be really hard to say, but we really do hope because it means that, there's an excess equity per share of 89 cents per share. So that 89 cents is basically their full year FY23 dividends, right? So they could possibly increase it by 100% and they will just be meeting their optimal CET1, right? So I'm not saying that we could see 100% increase in dividends, but there's a hopefully they'll maybe do it maybe 20-30% kind of increase in their DPS. So that's why we chose OCBC and why it stands out for us. So we do have an accumulate call with a target price of $18.80. Their dividend yield is currently at 5.2%. Now, my next stock is UOB. So UOB, what makes them stand out again from the three banks is that they are diversifying into non-interest income and also into the ASEAN region, right? They're not just concentrating on Singapore because to them, it's quite saturated. And also, there's so much growth to be had in the Singapore market. Yeah. So based on this graph, you can see that their fee income, this orange line is just the fee income, the total income. And then it's a percentage of their total income. And then the blue bar here is just fee income. So you can see that, fee over total income, the sort of the percentage has been declining over the past few years. It means past few quarters. It means that they have been trying to push more on their net interest income, loans growth, in SME sector, which is what UOB is known really strongly for. But recently, what has happened is that they acquired the Citibank assets in ASEAN. So that has accelerated their growth in these sectors by around 3 to 5 years, according to them. And they're able to shift away from their usual, SME banking into fee income banking, into sort of personal banking, wealth management, and into these areas that they didn't really have much presence. So we feel that this will help them to continue to grow inorganically, right, outside of their usual into FY25. And I think the last factor for UOB is also that, they do they did mention finally that they are going to give some share buybacks, right? They previously were very strict with giving a 50% dividend payout ratio, and they said that that's all we're going to give back to shareholders. But it was very surprising was that during the last quarter's earnings, they mentioned that share buyback is possible, and also they're going to be very aggressive in capital management, mainly due to the CET1 being extremely high due to the new Basel IV requirements, which is why they are now turning the table around and say, we will give back. In what form, we're not sure yet, but they did say we'll give back. So I think there's also a reason why they performed quite well in the last couple of months, because that is a very different story to what they were telling for many, many years, basically. Yeah. So we do have an accumulate call on UOB as well, with a target price of $39.70, and they currently have a dividend yield of 5.2%. Yeah. So I think that's all for the banks. Now I'll hand it over to Darren for the REITs. Thank you.
Hi everyone, I'm Darren. So I cover the REIT sector. So first of all, for the REITs, the performance in 2024 wasn't that great. It was just down 6.2%. So that's a total return. So that includes dividends as well. So as we saw, the REIT share price over 2024, like Paul mentioned, was very dependent on the outlook, or rather the expectations of interest rate cuts. So we saw that the share price, it really recovered in the third quarter. But then after the fact that Trump got elected and the expectations of rate cuts, it really fell. We saw REITs as well, the return or the gains in the third quarter. So this chart actually shows the index price to NAV. So we see here that right now the REITs are trading at about 0.86 times price to NAV. So that is at a steep discount to its valuation of about of 1, of course. And you see it's trading at almost minus 2 times standard deviations, or rather 2 standard deviations below the mean of about 1.03 times. So at these prices, it's also at below COVID-19 lows. As you see, COVID-19, it was trading around 0.9 times. So based on that, we think it is a good time to enter into REITs because of the discount valuation. So that's one. And also for property valuations, especially now that interest rates have started to come down in a lot of countries, like for the US and Europe especially. So for US, of course, like there are some US pure play office REITs. So that's a different case where we still expect some property devaluations there despite interest rates declining, and we still expect some cap rate expansion there. But for some other countries like Europe, Cromwell or Stoneweg, basically Cromwell and Stoneweg is the same REIT, just that Stoneweg, they acquired the stake of Cromwell and the manager as well. So now Stoneweg is the new sponsor of Cromwell. So for Cromwell, we've already, or rather for Stoneweg European REIT, we've already seen in the mid-year valuations that there was some signs of cap rate compression. So as a result, some of their property valuations already increased. So that was in the mid-year. And for this year-end valuation, we also expect to see more cap rate compression. So as a result, we do expect some property valuations to be seen for Cromwell's, or rather for Stoneweg's fourth quarter year-end valuations, which the outcome will be out soon during the FY24 results. So some other countries like Australia, where you've seen interest rates still not is still flat and not been cut yet. So cap rate, we still expect cap rates to increase, or rather to expand in some of these countries like Australia because of that. And we still do expect some cap rate property valuation declines in countries such as Australia because of this. However, the good thing for REITs because of this interest rate cut is that recently there are a lot of transactions done, especially post the interest rate cuts. So in the second half of 2024, we've seen many transactions. Like the most notable ones was probably ION, the CLI CapitaLand. They divested ION to CICT, as well as Keppel DC REITs acquisition of Keppel DC 7 and 8. So all these were done at valuation or slightly above valuation. Another, the most recent one was actually just a few days back, where Keppel DC REIT, they divested one of their weaker assets in Malaysia. So despite that asset being one of the weaker ones, it was also divested at about 2% above valuation. So basically, we're seeing that most of the recent transactions are done at or above valuations. And we noted that the hospitality sector were those that could generate like double-digit transactions that were above valuation. Like for CapitaLand Ascott, they divested 2 assets in the fourth quarter, where it was done at about a 3 30% or 40% above valuations. Yeah, so that is this slide for the price to NAV. Yeah, so next is the DPU growth that we expect this year in 2025. So let me explain this chart. So this chart basically means the line here is the forward dividend yield, and the blue shaded area here is the DPU year-on-year growth of the S-REIT index. So what we've seen is that in 2022, because of the weak, like COVID, right? So we saw that the DPU here, the growth was negative. So it was about negative 5% for 2020, and it returned back to growth in 2021 from the low base in 2020, and it also grew in 2022. So that is a year-on-year growth of DPU, the absolute number. And in 2023, because of higher interest rates, we saw that the year-on-year growth fell to about 5%. And in 2024, also because of high interest rates, we saw that basically the DPU year-on-year growth is also down. So that is the chart on the right-hand side. So the left-hand side, basically, which is this and the line, it shows that the forward dividend yield has been increasing over the past few years. That's mainly because of the share price action, despite the fact that the absolute number of DPU is declining. But going forward, with interest rates coming down, and a lot of the REITs, they've already repriced their loans, like their fixed loans. It used to be, when it was locked in about 4 years ago, it was very cheap. And as a result, over the past year or so, they have already repriced the loans to the current levels. So going forward, we think any interest rate cuts, it will definitely start to benefit them from the lower percentage of fixed loans that they have going forward. So this is the chart for the forward dividend yield and DPU growth. So all in all, we just expect this year and next year, we expect some good DPU growth in most of the REITs, like the absolute number. So this chart it follows on from the previous chart. This is the 10-year dividend yield spread. So it's the forward dividend yield minus the 10-year Singapore government savings bond yield. So what this means is that basically the 10-year Singapore government savings bond yield, you can take it as though as it's a risk-free rate proxy. So it means how much you are being, this chart means how much you are being compensated for investing in the risky asset REITs versus the risk-free rate of the 10-year Singapore government savings bond yield. So we see that this chart over here it was hit the lows in 2023 because of the high interest rates where the 10-year bond yield was high and the DPU, or rather the dividends, were low. So as a result, it was very low in 2023. But going forward, we expect this number to go back towards its 10-year historical average, mainly because of the higher DPU, which will in turn increase our dividend yield, as well as the fact that interest rates will continue to trend downwards, and that will lower the 10-year Singapore government savings bond yield. So as a result, it will expand both ways. So we do expect that this 10-year yield spread to increase, and as a result, REITs will look more attractive going forward as compared to other yield instruments like the 10-year bond yield, the 10-year bond, Singapore government savings bond. So next we have a chart. So this is so-called our list of coverage, and there are a few numbers here. So the first column, which is this one, we see basically these first three columns are heat mapped. So we see, like for Lendlease Global Commercial REIT, for instance, the adjusted ICR is at 1.6 times. So recently in November, if you remember, MAS released the new guidelines where there's a single MAS limit of 1.5 times for ICR and a 50% gearing limit. So before they changed it to this, it was 45% gearing limit, and you can bring your gearing to 50% only if your ICR is 2.5 times and above. So now they've relaxed it to 1.5 times ICR and a fixed 50% gearing limit. So this chart, we've tabulated the so-called the risk. So you see the ones that are closest to breach this 1.5 times are Lendlease Global and Suntec REIT. So basically what will happen if the REITs, they breach the 1.5 times is just that they will not be able to refinance, they will not be able to take on more loans. And of course, investors will start selling down, especially if they breach this 1.5 times. So this is similar to what happened with Manulife. So if you remember, they breached their gearing limit of 50%, and as a result, they are now in their recapitalization plan and recapitalization phase. So of course, the investors started selling them down, and they could not really borrow new loans. They could only refinance a loan. So that's the issue with breaching. And for Lendlease Global, another thing is that now that at 1.6 times, is that they still have perps as well. So for their perps, it's about 350 million perps. So that might, if they refinance these perps with, let's say, loans, then the gearing will continue to improve. But the fact is that there will not be much difference because this adjusted ICR already includes the perps interest. However, even though it's trading at 1.6 times, we do think that the risk of them reaching this 1.5 times ICR is not very high because, first of all, going forward, they do intend to divest their GEMS office, and that will likely help them when they pay off their debt, will lower the interest cost, as well as the fact that interest rates are already starting to come down. So going forward, we do think that the adjusted ICR rate, it's unlikely that they will breach this 1.5 times, but it is very close. So Suntec REIT now is at 1.9 times. It's also similar. They're also trying to divest some of their strata office units, so that will help them. But basically, for this new leverage limits and the ICR, it benefits these two REITs only, Suntec REIT and Lendlease mainly, because of the fact that they are gearing and they still have some perps that are due. So moving forward towards the gearing ratio, the one that's at higher risk under our coverage is Prime US REIT. So that's at 47.8%. So they've refinanced their loan already. So that is the biggest hurdle for them in 2024. But going forward, we still do expect some property devaluations in the office sector, as we've seen Manulife did recently that they divested some of their assets at 30% discount to valuation. So as a result, we do expect that valuations might decline. But management during the third quarter conference call, they are quite confident that they will not breach this 50% gearing limit based on the fact that the assets will, based on the reason that the assets, they do not think it will devalue that much. So they think they are still in healthy territory, but we are monitoring that and we are wary of the fact that they might actually breach this 50% gearing limit. Yep, so that is for gearing, and the other counters are still relatively safe, but despite the fact that the gearing now has changed to 50%, we still think REITs will still want to keep or rather maintain within the 45% gearing limit instead of just straight away, because of the new limits, they will show you increase our gearing to 50%. Yeah, we don't think that will happen. But that might happen gradually over time, like over the next 5 years or so, but not immediate. So the next column that we have here is the percentage of loans that are fixed. So this one, it really, like the lower the interest rate that are fixed, like for Faiz Hospitality Trust, 50% or 40%. So they'll benefit from the lower interest rates rather like quicker or faster than the other REITs, where if let's say their loans are at 86% hedged, they'll take longer to benefit from the lower interest rates. So like I mentioned just now, a lot of the REITs, they've already repriced their loans for the fixed portion. So going forward, they'll just benefit from the floating portion. So the lower portion of loans fixed, the REITs will benefit from lower interest rates faster. And the next column is basically the perpetual bonds with next reset date. So I just compiled those with perps. And yeah, the ones that are at risk are Lendlease and Suntec. Yeah, and then the last column, we have our PSR recommendations. So right now, I'll just run through some of my subsector preferences. So for all the REIT sectors, personally, we favor the retail subsector. That's mainly because we still expect positive rental reversions going forward. So for downtown malls, we expect in the teens positive rental reversions, and for the suburban malls, we expect about a high single digit. So some of the reasons that back our claim is, first of all, with international visitor arrivals and population growth in Singapore, we do expect the state tenant sales to improve. So tenant sales we saw in 2024, it wasn't that great. Some of the REITs also, they showed tenant sales declining, but tenant sales it's more of a backward-looking statistic. Well, a lot of these REITs, the tenants, they are confident in the outlook of tenant sales, so they are willing to pay higher rents. So some of the new concepts as well, like there's Chinese F&B concepts like your Mala Hotpot, all these, they're really coming to Singapore and they're demanding a lot of space, so they're willing to pay higher rents as well. There's also a strong shift towards health and wellness post-COVID. So that also helps to increase the demand. And also there's also limited incoming supply coming into the retail sector. So all these factors will help to support the positive rental reversions for retail. So basically we favor the retail subsector, and the other three subsectors like industrial, hospitality, and what was the last one? Industrial, hospitality, and I remember that. So for next, I'll move on to hospitality. Hospitality, we are neutral mainly because of the fact that in 2024 there was a very strong base, and in first quarter 2024 as well, it was there was Coldplay and Taylor Swift, so that really boosted the RevPAR numbers. So we think that going forward in first quarter 2025 especially, we don't think that the hospitality numbers or RevPAR numbers can match last year's numbers, but we still think overall over the course of the year with improving international visitor arrivals, we do expect it to recover back to 2020 pre-COVID levels like in 2025. So that will really help to stabilize the RevPAR, we think, and we believe RevPAR will still grow in the low to mid single digits in Singapore especially. And some of the things that boost this or help support the RevPAR growth is like the expansion of the Sea Oceanarium. So that is one, as well as the Minion Land in USS. Yeah, so next is office. So office basically last year there was a lot of supply that came onto the market. So that was from IOI Central Boulevard Towers. So that was about 1 million over supply that entered the market. And as a result, once it completed, the vacancy rate of the Singapore office is now at 7%. So it started 2024 at about 4%. And because of this new supply, the vacancy is at 70%. So IOI, despite the fact that they target the higher market, a lot of the REITs, right, we still think that they still can benefit from slight positive rental reversions for office, because a lot of them, the REITs, the rents, they are currently paying rents that are under the market rate. So a lot of the REITs are under rented for their office. So we still think when they bring back their rents to market rate, then they will have some slight positive rental reversions there. So that is for office. But going forward from the new supply from Keppel South Central as well, so that will really affect the office rents. And we saw office rents plateaued in 2024 at about 11.95 for a grade A office. So we think that will likely remain or even start to come down with the new supply that's incoming. Yeah, so I spoke about office, retail, and hospitality. So the last one is industrial. So for industrial, we saw since COVID 2020, right, there was a huge boom in e-commerce. So as a result, the warehousing and logistics space, the demand for that really shot up. And as a result, rental reversions over the past few quarters or past few years was very high in the double-digit levels. So going forward, because the fact that the rents already risen so much, we think for prime logistic rents, it will start to slow and maybe towards the mid to high single-digit levels going forward. So that's for logistics. Business parks, it still remains very weak. The weakness flows through from the weakness in office as well. So right now, the island-wide vacancy for business parks is over 20%. So we think that will remain. And yeah, so that is for logistics space. So that's basically my outlook for those sectors. So I'll just move on to property for a quick one. So this is basically the new launches and take-up rate chart. So over the first 9 months of 2024, there were about 3,200 plus launches, and the take-up rate was decent. The take-up was mainly from Singaporeans and PRs. So we saw in the fourth quarter, there were about 4,000 launches, and I'm sure many of you are aware that the take-up rate was quite decent in the fourth quarter. Like, especially since the interest rate cuts, and we've seen sentiment really pick up since then. So we see some examples there. I put like Emerald at Katong, Norwood Grand, they had some strong take-up rate of over 80%. Mayor Blue also had 50%. So we noticed that the higher end luxury products are still put on hold, and the demand is still not very strong for those products, like the core central region as well. Mainly because the foreign buyers have already disappeared since the hike, ABSD hike to 60%. That was 2 years back. And since then, the market, that high-end market has not really recovered. So the demand we see is still mainly from Singaporeans and PRs. Yeah, and going forward in 2025, we think this might start to pick up with the lower interest rates. And there are quite a lot of units that are expected to be launched in 2025, 14,000. So we are monitoring this situation. But other than the fact that interest rates are cut and the demand might pick up, you still see a lack of catalyst for the property sector. So which is why we still have a neutral call. Yeah, I'll now move on to our stock picks for dividend yield. So first of all, we have Stoneweg European REIT. So this is basically the new name for Cromwell since Stoneweg acquired their Cromwell stake and stake in the manager as well. So first of all, Stoneweg REIT, we like them because they are resilient. They're a very resilient portfolio that really survived COVID as well as any like the Ukrainian war and such. So this chart, it shows the DPU growth, or rather the absolute number of DPU and portfolio occupancy. So portfolio occupancy remains stable over the past 4 years or so at about 94%. So that's despite all the headwinds I mentioned previously. And it from the face value, it doesn't look good that the DPU is falling. Like from 17 cents in FY22, it fell to 14 cents in 2024. But that's mainly because over the course of the past few years, there was cap rate expansion from the high interest rates, and as a result, property valuations started to decline. And for Cromwell, they took a proactive approach where they started divesting their assets to keep their gearing within 40%. So this is definitely very strong capital management from our perspective, as compared to some other REITs, like for Manulife, for instance, where they breached already, then they started taking action. So that is a different situation totally. So another thing we like Stoneweg European REIT is that right now they are paying a high dividend yield of 9%, and that is a forward yield. That is after taking into account the fact that they've divested a lot of assets, and they divested about 300 million euro worth of assets, and despite the absence of contribution from these assets, they are still paying about 9% yield. So this is already taken into consideration. But going forward in FY 2025, they do have one more refinancing to be done. So they plan to issue another bond. So that bond expires in November 2025. So that is a 450 million euro bond. So the bond right now, the interest rate is only at about 2.125%. So when they refinance this bond, it will likely be about at least 4%, we think, based on current market conditions. So as a result, the interest rates, or rather, the interest rates will increase in FY25 is this year. So we do expect the DPU to decline further, but based on 13.41, DPU is still paying a dividend yield of over 8%. So we think that's attractive. And like I mentioned inside my previous slide, we think that the ECB, since they cut so many rate cuts, like they had 4 rate cuts previously already, and we still think there are many more rate cuts to come for them. So as a result, we expect more cap rate compression. And as a result, we do expect valuation uplift in their portfolio. So these are the factors why we like Stoneweg European REIT. So next we have CapitaLand Escort Trust. So we like them because of the fact that they have some inorganic growth as well as organic growth. So this chart, it shows the portfolio RevPAR. Basically, it has already recovered to pre-COVID levels, and we still think there is room for growth. So their geographically diversified portfolio will help to offset some weakness in some markets. Like this year, we think there's some weakness in Singapore, but like stronger markets like in Japan can offset this weakness. So we like them for this reason. Also, the fact that they have some growth income as well as stable income sources. Like for instance, in FY 2022, or rather this year, they re-signed, or rather they renewed their lease in France. So this restructuring of the lease in France is now based on a master lease, and they are getting fixed rent instead of fixed plus variable. But this fixed rent is already 4% above 2023's fixed rent plus variable rent. And this new lease is also CPI index. So basically they will get the benefit from any inflation. So this is a stable income source for them. So their organic growth is set. And for inorganic growth, we've seen recently, like I mentioned, that the fact that they've divested some assets at like 30-40% above valuation. So that is where the inorganic growth comes from. And they still have about 350 million of previous divestment gains that they can just top up DPU if they have the discretion to do that. So in 2025 and 2026, they do have some AEIs that are upcoming, and they do intend to pay out some of these previous divestment gains to help offset the impact of this loss of income from the AEIs. And CapitaLand Escort Trust, despite being a CapitaLand name, so it's still paying a 7% dividend yield. So we think this is very attractive at this price. I think right now it's 87 cents here. So we have a buy call on that. And for CLI, it's not really a dividend yield play, but for CLI, we like it because of its 4 pillars of FRB, the fee-related business. So they have listed funds management, private funds management, capital commercial management, as well as lodging management. So we expect all these segments to grow. So with the lower interest rates, like we've seen Ion Orchard, the divestment of Ion Orchard to CICT, as a result, we think rather it's a fact that the fourth quarter, they will have some very good management fees that they'll collect from the event-driven fees from this transaction from CICT. So that will really increase. And going forward, we also think because of this lower interest rates, basically event-driven fees for both the private funds and the listed funds management platform will also increase. So that is a boost for them. And we've also seen their FUM, which is their funds under management, it really shot up in the fourth quarter. So that is from the acquisition of a stake in the SC Capital as well as Wingate. So the fourth quarter, their FUM, it really grew by 15 billion. So that is on track to hit their 200 billion FUM target by the second half of 2024. So these are the reasons. They also are trying to lessen or optimize the portfolio in China. So previously they had about 30% of their AUM in China. So now they're trying to reduce that. And going forward, there's still some weakness in China. So we do expect some portfolio valuation losses in China as well, but it won't be the impact of 2024's level where we saw like 600 million of losses in the portfolio. So they still have this 2.5 billion that they are looking to divest in China, and that will be done over the next couple of years. So yeah, that's for CLI. And yeah, that's all for me. I'll hand over the time to Miao Miao to talk about China. Thanks.
Thanks, Darren. Hi, I'm Miao Miao, rate and airline analyst. Yeah, I'll be going through re-rating of the China risk. This is a bit contrary to what we have commonly seen, and we're not here to say that there will be a turnaround on China's overall economy, since more than 30% of the GDP is contributed by the property market, and it's just difficult to fill in the hole. So far, all the stimulus government has been released are centered around the physical stimulus, such as lower capital reserve requirement rate and also lower the main policy rate. But the key point is, what's really driving the confidence is we know that the government is backing up the economy. We also do believe there's room to maneuver on the potential upcoming tariff, since like Paul mentioned just now, the tariff is to everyone, not only to China, so China won't be so badly affected. And we also expect support to come in from one single person, Elon Musk, who's the top contributor of Trump's last campaign. We believe he has a deep interest in the China market, since more than 20% of Tesla's income is generated in China last year. And there's also a mega factory in Shanghai, and would be his interest to support China's overall economy. There's other ways to get by the potential tariff, like China had done a deal before, just pre-COVID. They agreed to purchase more than 200 billion of the goods and services, and also initiated some intellectual IP production, and also opening up China's financial service sector. As a result, US agreed to cut the effective tax rate from 15% to 7.5%. So things won't be as bad as expected. However, we also would like to warn investors about some potential tail risk, such as the Patriotic Investment Act. Essentially, it means US will stop all the investment to China and withdraw all the existing investment to Chinese firms. This is like a nuclear option investment. No one will be benefited from it. Yeah, so we don't believe it will actually happen. It's just some tail risk we would like to warn investors. And so moving on to some stock counter picks. Firstly is China Aviation Oil. This is China Aviation Oil is the largest physical jet fuel purchaser in Asia Pacific, and it also plays an important role in civil aviation industry in China. Profit for CAO mainly come from two parts. Firstly, is this profit from associates. They own 33% of the stake in Shanghai Pudong International Airport, and that's the largest international airport in China. They are basically the monopoly in the industry, since they are the sole jet fuel supplier to all the aircraft departure and takeoff in Shanghai Pudong International Airport. So pre-pandemic, profit from associates accounts for more than 70% of the group's total profit. So with the increasing international air traffic, as it already increased by 70% year-on-year in November 24 and recovering back to 94% of the pre-pandemic level, we expect profit from associates increase at least by 50% year-on-year in this financial year. So it will increase from 13 million last year to 44 million this year. And apart from profit from associates, CAO also supply jet fuel globally. Essentially, this is the trading business, and CAO will be benefited from either the contango situation or some geographical mispricing stemming from the geopolitical uncertainties, such as the Red Sea conflict. We expect it to redirect some of the demand back to the Asian market. And apart, besides the very visible earnings, CAO also has pretty attractive discount to its valuation. It currently owes 315 million cash in hand, and cash alone is making up about 50% of the market cap, which we believe is pretty attractive. And most importantly, we believe the largest share price catalyst will be coming from its dividend policy. CAO announced 5 cents per share dividend last year, and with the exceptional earnings this year, we believe this would increase their payout ratio from 30% last year to 40% this year. Thus is translating to around 6% dividend yield, which we believe is pretty attractive. And moving on to the next counter, Zixing. This is our Chinese sweet potato operator. And we believe PetMate would at least triple this year. This is because Chinese is advocating food securities in China by allocating lands and also subsidies. So there are a few PetMate catalysts serving Zixing this year. Firstly, will be their fresh sweet potato products. We expect sales to at least double this year with the introduction of the cold storage facility. So this would extend shelf life from originally 1 week to more than a month now, thus enable Zixing to expand its distribution channel to somewhere such as the supermarket. And also, we expect sales to grow for its processed sweet potato products to increase by 30% this year with the introduction of the higher margin products, such as the nutritional products and functional products like the sweet potato powder. Zixing is also very actively expanding its revenue stream by converting agricultural waste into animal feed. And we expect the first batch of the revenue to kick in from fourth quarter this year and translating to around 1.7 million profit next year. Last but not least, we anticipate the long-term share price catalyst to come from the Hainan Rejuvenation Project. This is a joint development with City Construction, and that is the second largest company in China. Upon successful completion of the project, we expect the total cultivatable area to increase by 5 times. So Zixing will adopt the Euro business model, generating revenue by selling of the sweet potato and also processed sweet potato products. Therefore, we expect PetMate to increase by at least 5 times upon successful completion of the project. And moving on to air transportation. This is not related to China. It's just another sector we have been covering. So air transportation, the graph shows available 6 kilometer, which is commonly used as an indicator of airlines capacity. As shown on the graph, in November 24, it already surpassed its pre-COVID level by around 7%. This indicates there's fading recovery tailwind in the industry, along with decreasing load factor and also the yield. However, we do believe there will be marginal improvement in the airline industry. So we have a neutral rating on the sector on the back of the increasing recovery of the Chinese demand. However, the recovery demand will be limited because of 3 following reasons. Firstly is the intensified competition over the airfares as Asian airlines ramping up their capacity aggressively. And to add pressure on the top of it, we also anticipate improved supply chain efficiency in 2025. Therefore, there will be more aircraft delivery and adding into the capacity this year. Last but not least, we also anticipate weaker business sentiment to weigh down on the sector in 2025, especially with the ongoing geopolitical tension with the upcoming Trump administration. However, airlines remain the top beneficiary of the expected decline of the crude oil price, as the market is generally anticipating unwinding of OPEC production cut, which will subsequently lead to lower fuel price. So jet fuel cost yearly accounts for 30% of the airline's total expenditure. And we believe with the lower jet fuel cost, this would support airlines' profitability in 2025. And moving on to my last country, SATS. We believe FY25 is going to be an exceptional year for SATS, and its profit will be mainly supported by the cargo handling side. Yeah, as shown on the graph, cargo carried increased by 13% year-on-year in October 24, compared to a substantial decline of 13% pre-pandemic, which is October 19. Yeah, so we believe cargo momentum is very likely to sustain in 2025, at least before the implementation of the tariff. And SATS is well positioned to capture its increasing market share after acquisition of WFS. Additionally, we also like SATS because of its substantial pricing power. They just successfully repriced SIA, which is one of its major customers, accounted for 70% of the group's revenue last year. So SATS also view contract repricing as an ongoing and progressive process, with inflation being a global issue and majority of the contracts being indexation linked. We believe there's more opportunity for SATS to reprice their customers. Thus will further boost profitability in 2025. Yeah, that's all for me. I'll hand over to Paul for the rest of the things.
Okay, thanks, Meryl. So we just move on to another area where we think investors can at least generate alpha, which actually is profit, but alpha just to make it sound so sophisticated. So we still like Keppel Limited. So for Keppel Limited, we think they're riding the whole data center wave. Of course, data centers now is in huge demand in Singapore. I think Keppel DC just repriced their rentals for data center by 40%. So there's a shortage of data center and there's a lot of demand for data center. So how is Keppel benefiting? So of course, you need power, and there's going to be a huge amount of power demand in Singapore, not only because data centers, but also EV cars that's coming up from Singapore. So power demand for Singapore for the next 10 years is going to be very strong. So we think Keppel can benefit from it because they're going to have a new power plant. And not only is the demand strong, but there's a lot of old power plants. I think we all saw Hyflux. So since Hyflux, nobody want to build a power plant until recently. So there's still also a lot of old power plants that's going to be decommissioned. So that's why the power sector is still going to be very strong, at least for the next few years. The other thing where they're benefiting is that they're also importing power, which is the easiest to do. I don't have to build, not so much work. I'm not going to build a power plant, just import from Malaysia, import from Australia, from Laos. So that's the other area where they will benefit. They also built a submarine cable, transmission cable to be completed, and prices is also doubled there. So that's why we think Keppel will benefit from this multiple ways that are going to benefit from this huge data center wave. They've also got a green of capital. They also have fund management now, so they also have a lot of capital on the side to actually to build more green. So this is going to be the big growth driver for Keppel. And more importantly, we mentioned power demand in Singapore is going to rise. I think last year demand was only like 1%, but you're talking about 3 to 5% for the next 10 years. Of course, near term, we think the results may not be strong for Keppel because Keppel, what happened was last year they sold a lot of Chinese land. So that, of course, we're selling any land in China now. So that's why the earnings will be a bit softer in the near term. But the key to watch in 2025 will be asset monetization. They still plan to sell, to dispose of asset monetization, i.e., sell furniture, about 4 to 5 billion the next 2 years. The big one to watch will be AssetCo. So in AssetCo, they have like 13 rigs. Half are not built, but half is built. So they can at least sell the half that's already built. And there are many ways to do it. They can either sell it or they can push it into build a fund and then get investors into it. And of course, the final one will be a M1 merger. M1 merger, I mean, nobody knows the exact timeline, but one key pertinent timeline will be June 2025, because I'll describe later, because there's going to be a big payment by both sides for spectrum. So we still like Keppel. Near-term earnings don't expect very strong, but I think in the medium term, they're riding on these multiple waves. For Singtel, so if you look at this chart, the red line is basically the market cap of Singtel. So of course, you saw Singtel's share price suddenly surge up. It's not like everyone is queuing up at the Singtel to go to buy a new mobile phone. But what happened was actually they benefited from Bharti Airtel. So they have like about a 29% stake. So you notice that when their market cap in Bharti Airtel was almost the same as Singtel. So I mean, virtually everything is free, but at least this is on paper. That really helped the Singtel share price to move up strongly. So then what is happening now is that we still like Singtel because of course the yield is attractive, but at the same time they are on a monetization path. They will be selling, they almost explicitly mention it, but they will be selling Bharti's stake. They won't sell everything, they'll sell probably 1 to 2%. Because they're trying to equalize the stake between what they are 29% and the other major shareholder. So there will be sales, and then there will be, of course, special dividends given to everyone. There's also another thing that they could be selling is InTouch. So it'll be more complicated, but InTouch merged with another company called Gulf, and then it's no longer non-core, so they will also be selling. And of course, keep on selling stuff as well. So they'll also be selling the Singtel Comcentre. So all this is going to generate profits, and also they're going to farm back up dividends. But in the background, Singtel is also doing well because Australia has always been the issue for them, Optus, because the return on Optus is only 1%. Basically nothing. But right now they're doing a lot of aggressive cost cutting in also Optus. So we think Singtel will be the other. Of course, StarHub, if you look at this chart, even this is the price of mobile prices in Singapore. Of course, 2008, 2016 was the best for Singtel. Best time to be a CEO. You don't have to do anything. The ARPU always was very stable. Then, of course, when competition came in, WhatsApp came in, then the price continued to come down. We actually thought when the pandemic happened, prices of mobile prices will actually come back up a bit, but it didn't. Because of the roaming competition. But again, this is a very problematic chart for any mobile operator. I mean, even chicken price can go up. So I mean, every year your mobile prices keeps on coming down. So a merger could be happening, and I think it's worth considering because I mean, StarHub is giving at least a 6% yield. They commit at least 6% dividend yield minimum. So if we are forecasting maybe 7%. So, but again, once the merger does happen, I mean, mergers are very painful. You have to cut costs. You have to make a lot of write-offs. So don't stay around for the merger. Just when the news happen, then of course they say bye-bye. But because mergers are very painful, and the one that benefits is probably Singtel because they can at least capitalize on less competition. But mergers are, you have to cut costs. There's a lot of write-offs. The other one is Thai Bev. So the problem for Thai Bev has been the valuation. So when you think of consumer and they are virtual monopoly, Thai Bev, most of the profits, 80% is from spirits, brown spirits, and they got like 90%, 95, or probably it's 99, but probably just say 95 just to not make it so monopolized. But even then, the valuations have continued to creep down. So one thing that could help the share price if they do a BeerCo stake, but this has been talked about for 2-3 years about, his valuations that he won is like 30 times, 40 times, which I mean, for a mature industry, it's going to be tough. But if you assume there's a 20% PE, which is better than their current PE at 12 times, that could also help stroke the share price for Thai Bev. The final ones, we don't cover, but I guess these are the hot topics. Of course, there's Olam, market cap 4 billion. if they were to sell their Olam Agri, I think the valuation is about 3 billion. So of course it makes sense the share price could also move. They also have another Olam Food in IPO, which the market cap could be slightly smaller, but almost equivalent. So if they do this, then they of course they will obviously also benefit. But no, do note that Olam is very geared. Now, Olam's finance cost is as much as 1.6 billion. So, of course, they're asking, like, how can a company have so much? Of course, this one is the chosen one. No? They have, like, maybe their shareholders, a sovereign wealth fund. But the rest of the small mid cap, sorry, you're all stateless, so no sovereign to support you. But for them, that's why maybe they can have such a huge finance cost. The next one, I think, probably going to be a lot of questions will be our Singpost. So for Singpost, there's a 1.2 billion market cap. And of course, if they dispose of the Australian assets, is 900. The Singpost Center alone is really as much as their whole market cap of the company. And of course, the problem when the issue you might have to worry about is once they sell the assets disposal of Australia, they give you special dividend, I don't know, 10 cents, 20 cents, pick a number. But you worry that the share price will also drop 20 cents. So in the end, nothing happened. But if that does happen, then I think it's a good opportunity to pick up because even after selling Australia, there is the Singpost Center and there will be a postal restructuring, which can only be good. I mean, you don't go do a restructuring and to make things worse, right? So they probably wind down a bit of the community part, but no, this year is a special year. Probably they won't do it until that special event this year happens. Because if you want to wind down community service, I think everyone's going to. I want to also buy my $2 stamp, and then I can't find my post office, so that one could be contentious. But so just do note that these are the things to monitor around. So I'll just run through our model portfolio. We have model portfolio again. In terms of the changes we did, we add a lot more banks recently, but because we think the fourth quarter could surprise. So like what Glenn mentioned, fourth quarter, the difference right now is the yield. We are banking on special dividends coming from the banks, buybacks from the banks. And also the one thing surprisingly is that loans growth is coming up. So that could actually re-rate the growth profile for the banks. Of course, we also have an initiation on WeHer, which I think my colleague will mention. This has been a performance. We were only up 9%. Again, this is just our own computation. So please, this for illustration, we were up 9%, but we were trounced because the banks did so well. So if you have a fund manager with 5%, then you say, I don't have to pay you because you did nothing. I could just bought an ETF. But again, this is just for illustration. I'm going to hand over, sorry to rush a bit. I'm going to hand over to my colleague who just talked about construction and our WeHer initiation.
Yeah, thanks, Paul. Good morning, everyone. I'm Iqban. You can also call me Ben. So I'm an analyst covering the construction sector. Okay, so this is on the chart here. You can see that the construction levels in Singapore has been peaking. So the trailing 12 months of contracts awarded from October last year is at record levels of around 44 billion. And the reason for this is because there's increased construction demand from both the public and private sectors. So for public sector, the main source of demand is from Changi Airport Terminal 5. And also there's quite a lot of HDB BTO projects which had a backlog from COVID. And from the private side, there's demand from government land sales, whereby the government will release the state land for private development. And also the expansion of the 2 integrated resorts, IRs. So as you can observe that the blue line will actually lead the red color line. So the blue line is the contracts awarded, whereas the red line means the amount of payments that will come in after the contracts are awarded. So as you can see, when the blue line, for example, when the blue line goes up, right, after 12 to 18 months, then the red line will follow. Also same, likewise, when the blue line come down, then the red line will follow after 12 to 18 months. Yeah, so this is the general trend that we see. So we do think that because of this recent peak in the blue line of contracts awarded, we do think that there will be a strong upward momentum in the amount of construction payments in the coming months. Yep. So as for our forecast for the next few years, even the Building and Construction Authority have forecasted that between $31 to $38 billion of construction contracts will be awarded between FY25 and FY28. So if we take the average average value, which is around 34.5 and 35, right? This is the average value, which is forecasted by BCA. And you can see that this value is quite above average of pre-pandemic levels. And that's why we also think that the construction levels will remain at a very elevated level for the next few years. Okay, next slide. Okay, so we recently initiated coverage on WeHer. So for those who don't know, WeHer is an investment holding company with different segments. In their first half FY24 revenue segments, their biggest revenue contributing segment is the building construction segment, followed by workers' dorm, property development, and the small segment is based on revenue. Smaller segment is the fund management and PBSA. So for those who don't know, PBSA means purpose-built student accommodations. And we title it as Unlocking Value from PBSA Sale because this is the title of our report as well. And this is a very major development from 2 weeks back, a very major announcement from 2 weeks back. Okay, so let's talk about the revenue segments first. For building construction, so what they do is they basically take in construction projects for residential, industrial, and commercial projects. So we do think that there is tailwind for this segment because of the construction demand which I presented in the previous slide. Next up for worker dormitory segment, they build and operate worker dormitories. Currently, they are operating the Tuas dormitory with around 16,000 beds. And this year in FY25, they are going to start operating a new worker dormitory called Pioneer Lodge. This Pioneer Lodge has 10,500 beds, which is a 70% higher bed capacity this year. Yeah, so we do think that this is a very major revenue and profits driver, which I will explain further in the next slide. For the next segment, property development, currently it makes up 70% of their first half FY24 revenue. Currently, they have 2 projects. Firstly is the Bartley View, which is a 115 units residential property. Secondly is Mega at Woodlands with 517 units industrial property. Currently, in the latest results in first half 24, they have already sold off 91% of Bartley View, and they have already sold off 97% of Mega at Woodlands industrial project. And management is optimistic to sell most of the remaining units by the end of FY24. Yeah, so I think the revenue for this segment will gradually go down because most of the units are already sold off already. Last but not least, for the fund management and PBSA operations, which I think a lot of you will be interested in, even though it contributes a very small revenue segment, WeHer is able to capitalize on this and unlock value after selling a stake in this fund management segment. Recently, they sold off 37.1% of Fund 1. So, sorry, just context. Within fund management itself, there's 2 funds. First one is Fund 1. Fund 1 holds around 5,000 Australia student accommodation beds. Fund 2 hosts around 500 student accommodation beds. And Fund 2 will start being operational. The property itself will start being operational in FY25. Yeah. So the context is that WeHer sold off around 49.9% stake to GIC of Fund 1 2 years back. And then right now they hold 50.1%. However, from this 50.1%, they are going to sell off 37.1%. So they are going to be left with 13% of stake in Fund 1. So this represents a one-off gain of $36 million. And we do expect special dividends to come in from the sale of Fund 1. Because historically, in FY12, 2012, 10 years back, more than 10 years back, after they sold off an industrial development project, they distributed special dividends. So we do think that this is a potential which can come in from the sale of Fund 1. Yep. Our recommendation is buy with a target price of 0.62. Okay, next up, I'll be presenting on a major growth driver for WeHer, We do think that the new worker accommodations called Pioneer Lodge with 10,500 beds will be a major growth driver for WeHer for the next 2 years. As you can see from, For FY24, we do expect a big boost because for their first half FY24 results, they already clocked in a 68% year-on-year gains in revenue and operating profits. And this gain is because of a very high rental rates for worker accommodations, because there's a very strong demand for worker accommodations in FY24. Then in FY25, the major driver will come in from the additional bed capacity from Pioneer Lodge. So considering this big boost in bed capacity, we do think that there's potential for 40% CAGR in revenue and operating profits for WeHer. Yep. Okay, next up, I'll be closing off this segment of our presentation. 2024 was a memorable year, so it's around, like what Paul said, it's around 2% shy of October 2007 highs, which means that, also means that after 17 years, the market went back to square one. Yeah. And then the second point is that, navigating 2025 will be daunting because there's a lot of unpredictable policies from the US administration, and then the risk will range from like a trade war to inflation coming back up again. There's 3 key themes to look out for in 2025. First one is lower rates. We think that there will be 4 rate cuts in 2025. Second theme is China re-rating, because we are not expecting a strong rebound in China's growth. And the third theme is corporate restructuring. Because we think that the restructuring of corporate assets, like what Paul said about selling the furnitures via public offerings will drive alpha, which means higher returns compared to the benchmark. Yeah. That's all for our presentation. Thank you very much for your attention.
All right. Thanks everyone, and thanks Paul and the team for their sharing. So we'll be now moving to Q&A. All right. So we do have colleagues that will be on every aisle. So if you have any questions, do raise your hand to actually ask questions. So now I invite Paul and the team to the stage first to get seated. Right. Okay, so we'll be taking questions from both online as well as the physical audience. But for the physical audience, we will only be taking from the main auditorium for now. Right. So if you have any other questions that might not be addressed during this session, right, we do have the Poems3 app, and they have an investing community inside there. They also can post questions inside there where the analysts also do look at questions and answer them as well. So do join us in the Poems3 community as well as their channel itself. All right. Okay, so without further ado, let's just check. Is there any physical questions? Right. So we have the first one over here. Right. Okay.
Hello, can you hear me? Yeah. So my question is basically the artificial intelligence is in boom, right? So 2 questions. One is now Trump is coming. So how do we see the technology space, especially the artificial intelligence, number one? And are there any specific stocks in Singapore in this space?
Okay, yeah, thanks for the question. If you want to play AI, really have to do it in the US, regretfully. So for AI, the exposure we have here would be mainly semiconductor companies that build equipment to make the AI GPUs. AI means GPU chips, which are semiconductors that are in the cloud. So like NVIDIA and AMD, I guess, want to be. So for that, the players that benefit has been, I think AEM will be one. But the problem for AEM is that one good, one bad, because they are building possibly for AMD. But at the same time, they're losing a lot of business from Intel. So that is the other one is, of course, recently has been Franken. So for Franken, when you're doing AI, when you do it's a bit complicated, but when you do a GPU chip, you need a lot of memory. and you need very, very fast memory. So they apparently have got because of the way it's been fixed thermal bonding, whatever. So that is the other company that would benefit. But to be direct about it, if you want to play AI, the bellwether is NVIDIA. That would be the bellwether. So if that doesn't move, I don't think any of these stocks will move. And one last point is that the AI didn't really benefit. You can see most of the semiconductor stocks actually down this year because the volumes for AI GPUs last year maybe 5-6 million, which is hardly anything. A mobile phone is 1 billion. So although you have the fairy dust of AI sprinkled everywhere, but the reality is that not many companies in Singapore benefit. You can move a bit. Maybe in Malaysia they're talking about maybe GPU as a service. So but essentially it's going to be NVIDIA and that's it. There'll be some supply chain. Everyone is watching who will be the users of AI. I think so far would be the big cap guys like Microsoft and all that. They have at least generated some revenue from AI. But Singapore, no, it's going to be tough. Yeah. Thanks.
All right. Any other questions from the floor? Over here, we have one. Yeah. So wait for the mic first, because we need to online to here also.
Yeah. You mentioned Fraken. So what's your outlook on companies like UMS, Fraken, the semicon space in Singapore for this year, 2025?
Oh, sure. Thanks also for the question. I think near term will be soft. I think fourth quarter isn't looking good. I think if you just take, so I'm just running through all the names. If you look at Franken, fourth quarter of 2023, they did very well because there was a lot of pull in orders. Pull in means because of the China ban. I'm talking last year. A lot of them pulled a lot of orders in last year. So this quarter, fourth quarter 24, I don't think earnings will be that strong. So I know this is a very momentum stock. One bad headline, the share price come down. So probably that would be the opportunity, I think, because they are still betting. ASML is still a major customer, and you can't build in Europe, not capacity, and also you can't build in the US because it's too expensive. So near term, I think big. UMS also could be weak in the near term because if you think again, that's last year, fourth quarter of 23, their earnings did very well because of also pull in from their major customer, which is, I think everyone knows, Applied. And why there was a pull in is that when Applied order from you, if you hit certain volume with Applied, that means if Applied give you a lot of sufficient order, you get a big discount. So for Applied, there's staff everything in the fourth quarter. So this quarter, fourth quarter, we think the earnings will also be a bit weaker. But having said that, I think semicons, after 2 years of very weak performance by the Singapore names, I think a bit more positive because the destocking has happened, and I think there could be a reordering cycle. I don't expect very strong, but I think if you think about the pandemic, a lot of PCs were ordered, a lot of smartphones were ordered 2020, 2021. So if you do a 4-year cycle, there should be a reordering cycle. But these are not super high growth reordering cycle, but I think it will be a bit more positive for the semicons. But you just have to weather this weak earnings for the coming February when they announce. Then probably that to me could be an opportunity. Again, this is my thoughts.
All right, thanks, Paul. Any other questions? There might be for other analysts as well. Yep.
Sorry, just follow up on the AI question. How about those stocks in China and Hong Kong? Would there be any potentials there because they are competing with the US and the valuation are pretty low?
Yeah, so I don't really follow the apologies for that. I really not in the position. I don't really totally follow. I know there's only one company here. I mean, just to sidetrack, Valleytronics is trying to do this GPU as a service. We think it will be successful. I mean, the numbers will, because there's a huge demand. But I'm really not sure. I know there's like SenseTime and so forth coming up, but I really don't have, we don't have much interaction with them, don't follow. So apologies, I can't probably give you a wrong answer. So better not to answer. Sorry for that. Yeah.
Yeah, so you're interested for the Hong Kong market. We do also have our Hong Kong session, I think, on Tuesday. So you can join us also for that session. So let's try to concentrate within the Singapore market for the questions for today. Any other questions that we do have? Just now I saw one. Yep.
This past few months, the electronics factory index has been going up. Can you share something on Venture Corp? I noticed this counter is not moving much.
Yeah, I think Ventures earnings has been downtrend since 2017 when the peak. So we have a neutral call on it, but it's very the thing is that we don't really see any near-term recovery, but they got a very attractive yield. So the yield is probably as high as 6%, if I'm not mistaken, because they got 1 billion of cash. So for me, it is more for the patient investor because I'm still collecting a 6% yield. There are some names that you should watch, although I'm not sure they are but one of the things to watch is, I think everyone knows, so you can always, is the heated cigarette, is it Philip Morris? So if Philip Morris were to get the heated cigarette IQOS into the US, then I think this stock will run. So the thing is, as an analyst, people want to know, or don't tell me 2 years, you tell me whether next quarter. So for me, next quarter, probably the earnings may not be that strong, but you are being paid. I mean, you're still getting a 6% yield. So for me, I think it's although you have a neutral, it looks attractive because expectations are so low. Nobody is expecting anything. After 2017, the stock earnings has been on a downtrend. When you're getting 6% yield, which I think fully backed now, they got 1 billion cash. So for me, more like a waiting game for them when they can. So that's my thoughts. The earnings are still probably going to be flat this year. But the market for electronics is flat. Nobody buys you. They want to get some excitement. So, but at least you're still getting a yield. Yeah.
Okay, maybe we have the last question for the physical. We have one over here. Yeah.
Well, actually, I have a question for SGX. Right. The government made an announcement that they will be working with SGX to see how to improve the terms and security they are in. So, what is your view, and will they actually succeed? Given that they find this situation.
Okay, so let me repeat the question just for the online audience. So the question is actually on the SGX and the collaboration with the government to see whether this collaboration will have any effect or any purpose or will work in a sense. So upcoming, what's the expectations of this collaboration for our analysts to answer?
Yeah, I can just tell you what I'm looking at. I mean, if the reforms do come up, of course, maybe better reporting or that. What's the point? I mean, just save a bit more paper. That's all. But not going to attract a lot more IPOs coming in. Most important would be a demand. So I think we highlighted before. You need some demand to come in. I mean, of course, funding analysts to write more reports, I don't mind, but not sure people are there's going to be a long queue. So why do people, when you speak to some of those expiring IPOs, a lot want to go to Malaysia. Why? Because the PE is higher there. So what I'm watching for is maybe at least some seeding of funds. You can see maybe seeding my own wish list. You can just see the ETF. I know, of course, Phillip Capital is very strong in starting ETFs. But if you want to start an ETF, you need at least seed capital 20 million to them, unless it won't work. So if they don't want to invest directly, at least seed. So you need to address the demand. Otherwise, maybe like I said, the annual report thinner a bit, disclose or make more things. It's going to be tough. Yeah.
So do you think the current price SGX value right now, are they running small blocks right now? So are they running pretty like 5 or crash? There's no coming back. They're all small.
I think, yeah, so just repeat your question for the general audience to hear online as well. Yeah, just asking if the SGX's share price of $12, whether is it running on fumes and is it stable, right? Where do we see going into the next few years? I think near term, you can see that their volumes have been doing quite well, right? I think it's really market dependent. So you can see, both their securities and derivatives volumes have all performed very well. I think so for first half of FY25, which they're going to announce soon, I think we'll see quite good figures, right? But whether is it running on fumes, their share price has not really moved much, right? Although we are in SGX, so I can't really say anything that bad, but it hasn't really moved much. So it has been very stable. So we'll see that their volumes, that's the main driver for revenue and for profit. It has shot up so much, but their share price just move a little bit sideways, move up a little bit, right? And I think the main question a lot of the investors are looking at is, I think they're asking how are they going to return, this good set of results they're going to have? how are they going to return the shareholders? So they have a very, I wouldn't say odd, but very different kind of dividend policy where they do this incremental increase to their dividends, right? Instead of having a sort of a dividend payout ratio where they return a certain amount. So in good times, they give back more, and bad times, they give back less, which is understandable to an investor. Yeah, so they do have this, they're trying to cap their dividends, say we will not go below this amount. But then in good times, of course, then the shareholder gets sort of, they don't benefit. In bad times, they benefit maybe slightly, right? So I think that's the main question you can ask, whether or not it is sustainable, right? They need to possibly, change their dividend policy slightly, right? To better reflect how well they're doing, or, bad times, you write reverse, basically. That's what I think they need to do. But looking for the next year, I would think that they're going to do quite well, right, in terms of revenue, profits. Of course, treasury income is something to look at. It still makes up around 20 to 25%, right? So it goes with the interest rates. So that's something to watch out. I think we'll see how much they are affected in the upcoming results. You also see, when we post our findings on their results. But I think the next results will be quite interesting to see where are they heading, whether or not they can offset sort of their treasury income loss with like volumes and whatnot. And I think most importantly also their OTC FX line. Yeah. So I think it's still quite sustainable for now. Yeah.
Right, thank you. And thanks for the online, for the physical questions and my colleagues helping. So now I'll move on to the online questions. So the first one is actually on what is the outlook for Genting Singapore. So I'm not sure who will answer this question.
Yeah, we don't have official coverage for Genting. Probably no need now. But we have a bit more negative view because so for Genting, we thought they could. What happened for Genting was that the VIP segment just collapsed for them. And in general, when you see VIP demand collapse in the third quarter, it's not going to come back in the fourth quarter. So, and despite the huge amount of Chinese tourists that were in Singapore, you didn't see the pickup. And it's not only Genting Singapore, it's also for Marina Bay Sands. So I think the next 3 quarters is just going to be weak for there's a bit of luck factor, but for us, we have a bit more negative view on Genting because even though with the surge in tourism, the numbers didn't really move much. Yeah. Because I don't think the VIP, because of what's happening in China, has totally affected them.
All right. Another question that we do have is for Paul directly. Any views on ComfortDelGro itself?
We still be a year of growth. We were just a bit disappointed because most of the growth is coming from acquisitions. We were hoping that the organic growth would have been stronger for them. So that's why we took it off from the model. Yeah, after so many years of painfulness. Yeah, you still be growth, but just that the reason why they spend almost $1 billion, I think, for 800 million to make all these acquisitions. But we didn't really see where the synergies are coming. I mean, easy to buy, but no, after that, no, it wasn't really, for us at least, it wasn't really articulated well after spending so much. So that's why we're a bit more concerned. That's why.
Right. Another next question is, what is the reason for the revised down of the target price for Zixin from the 0.056 to 0.035?
We actually didn't revise the target price down. Oh.
Yeah. So just to clarify on this, sorry if there's a bit of confusion, but the fundamental recommendation still remains as a buy at 5.6 cents target price. But just now for my technical slides, I gave in terms of TA, I gave a target price of 3.5 cents for the first quarter this year. Yeah. So that's the difference between the technical outlook target price as well and the fundamental target price. I hope this clarifies things.
All right. Thanks for the clarification on that between the FA and the TA. Okay, so any views on Parkway REIT?
Yeah, so for Parkway Life REIT, we don't cover them. So, but my personal view is that they are trading at a high price to NAV, so that is really not very attractive, like more than 1.5 if I remember correctly. And the fact that their dividend yield is also about 4% or so. But the good thing about them is that they have restructured their Singapore leases. And I believe the increment in income will start kicking in next year. So you'll likely see some improvement in their DPU from there. But for healthcare REITs, there are two in Singapore, Parkway Life REIT and First REIT. We prefer First REIT compared to Parkway Life REIT. First of all, because First REIT, they're paying a stable yield of about 8% or higher. And they do have a base 4.5% rental escalation for the majority of their portfolio, which is in Indonesia. So that will help to, the base is there and the income visibility is there as well. Yeah, so that is why we like First REIT better. And the fact that this 4.5% base rental escalation also can help to offset the currency impact from the Indonesian rupiah. Yeah, so that is our take for First REIT versus Parkway Life REIT.
Okay, so we'll be having the last question from the online audience. All right, so this question itself, they phrase it a bit more for the US market, but I will just alter it a bit. So the question is actually US dollar against Sing dollar. Is it expected to go up with a drop in the interest rate, in the upcoming interest rate movement? And also, what is the relationship to the equity market as well as the gold prices? So maybe anyone can share view, maybe more on the banking side as well as the overall economy.
It's like my Q&A session. So for whenever you, this is a very basic thing. When it comes to FX, it's always grounded on interest rate and economic growth differential. So that's the basic grounding. So whenever we get this question, we just go back to these two key foundation. So when you look at US dollar, it's probably going to strengthen further because the interest rate is higher than many other countries, even Singapore, and also the growth is also far better, maybe a bit equal right now with Sing dollar. So for us, we think there's still more upward bias for the US dollar, and for gold. It really depends whether China is buying more gold, and recently they've done so. So I think I never liked it personally. I'd rather put money in FD than put in gold. But anyway, we think that gold price can still recover because if you have falling interest rates, it only benefits gold. And it was surprising that even when interest rates went up, they actually did rally recently. So for us, we're still positive. We think gold has still movement because I think China is still purchasing a lot of gold. I think recently the data shows. Okay.
Any views on the banking outlook? Within Singapore banking sector with the interest rate movement?
Oh yeah, I think I did speak quite a bit earlier lengthily about how the interest rates will affect the Singapore banks. So we do feel, in our opinion, that the Singapore banks are quite protected. If you think about sheltered from the lowered interest rates, right? With the excess deposits, they're able to, put it outside, not just into loans growth. They're able to move it away from that sector and still get a good margin. Although it lowers their margins a bit, but net interest income is quite protected, and it will even creep up a little bit. Although interest rates, margins all went down. Yeah, I think the main factor for the banks with the lower interest rates will be, of course, loans growth. We would see a steady pickup, mid-single digit, maybe possibly high single digit. So that will be the turning factor for the banks when we enter into 2025. That will be how the banks will continue to grow. Besides, of course, the what is happening now with the fee income, wealth management, trading income. Yeah, so I think that's the thing that we are uncertain of. How much will it improve by? The upside, of course, on the higher side will be high single digits loans growth. But I think mid-single digit is quite possible looking at the figures that we have now in November, that we had in November of this year, or last year, sorry. Yeah.
All right, thanks. So that's the last question for Q&A. I do see still quite a lot of interesting questions that we have in the Q&A box that we might not be able to answer all today. So as I mentioned, on the screen, you can see a QR code. You can join the P3 community. You can ask questions there. The analysts will actually share. I will also share some of the more upvoted questions to the team, so they can also answer on the community group after they are done today. And if you miss any parts of the question of the session today, right? So this session is recorded and it will be uploaded on YouTube itself. So you can review the session there itself if you want to look back to any segment or parts that you might have missed along the way, or if you came in late. All right. So thanks everyone for joining from the online side. Right. So for the online participants, we will be ending the session soon. Right. The next one we have is another session for the Singapore Treasury Stock Pick on Monday. You can join us there as well. So Tuesday also have the Hong Kong session, which is more popular. So you can also join us on the Hong Kong session on Tuesday for the Zoom session. Right, so we also have the feedback form for those that are online with us. Okay, so those that are here physically, just bear with me for a while my colleague and some setup from the other side. Right, so we'd like to thank the team, and we can maybe we can go down and have a rest. Thank you.